All right. Okay. Now we're going to get your predictions for 2024. We're going to talk
Ah,
about, I want your prediction for inflation, for interest rate, and prices.
at
Okay.
the
And
end
then
of the
one
year.
at
At the
the
end
end
of
of the
the
year. So
year.
I'll
Yeah.
give you the question. I'll give you the
Okay.
question. Okay.
Wait. Let's
US
see.
inflation rate in January
Sis,
2025.
sis, boom, ba. Name the sound of an exploding sheep. Um,
Okay.
what? Say that again.
Okay. US inflation rate in
Yeah.
January 2025. Higher, lower, about the same.
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
I'm Patrick ONeill, principal broker owner at Luxury Homes International, and with me today is Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, it's good to see you again.
Aloha, Patrick.
All
Kuhi
right.
Fachoi. Happy New Year.
All right. All right, so we're going to do actually a recap of last year, and we're going to look
Hmm.
forward into 2024, get your projections, predictions. We're also going to look back a year ago and see what you predicted for right now and see where we're
Ah,
at.
shucks.
It'll be good fun. It'll be good fun.
Busted.
Yeah, busted. So I want to start with the Fed news. Yesterday, Chairman Powell came out and stated the economy is expanding. The core PCE stood at 2.9%. The Fed funds rate would remain unchanged. Now, you emailed me and found his talk interesting. It seemed like no news to me. What was interesting to you about it?
Well, it was interesting. The core thing he evidently felt he needed to do was push back a little bit on an over-enthusiastic bond market that has kind of done a 180. All last year, they're telling us there's going to be recession and, uh, because the rates are high and whatnot. And then it looks like that's not going to happen now. And the recent data suggests that we've moved all of a sudden, maybe in the last 3 to 6 months, more quickly than was expected to a low inflation without the untoward unemployment outcomes that often and typically would have come from Fed tightening. So he pushed a little bit back on that kind of sentiment that under those circumstances, maybe the Fed should start lowering rates sooner than later. And then there were many more nuanced kinds of issues that were raised. I'll mention a couple. The role of productivity growth, which if productivity growth is relatively high, then it's been low in recent years, notwithstanding all this cool technology we have. And there's some mystery about that because it did surge after the internet, was unleashed in the 1990s. But remote work was thought to have initially to have had a positive impact on productivity, and it did during the recession because even though people lost their jobs, a lot of work kept on being done, right? Because of
Mhm.
people being able to work remotely. More recently, and the question of AI, right? Is that going to affect productivity? Maybe not as much right away as eventually, if we're lucky. And if we're lucky, it'll be a positive impact. And then this question of if the balance sheet, if the Fed's balance sheet is shrinking, and that part of the Fed's effort to keep interest rates lower by buying securities is going away, is that independent of, or will it have to be synchronized with the eventual reduction in short-term interest rates that the Fed itself projected for later this year, maybe mid-year? And in fact, the median forecast of the committee was about 3 rate cuts of maybe a total of 75 basis points by
Mhm.
year end. So it was interesting to me as an economist, more because of the nuances, and then this point that all of a sudden he's pushing against the bond market, which a year or two
Right.
ago was worried about inflation, and now they're like
Right.
they've gotten over it overnight. Yeah,
You've consistently said US was not heading into a recession, barring a geopolitical or biological event. Right now, there's a tight labor market, at 3.7 unemployment across the US.
yeah.
GDP last quarter was up 3.3. It seems like the Fed has got us to a no landing. I feel like we haven't even landed. Is this the proverbial soft landing? Pretty good.
Okay,
Pretty good
yeah,
landing.
the soft landing has to do with inflation coming down without people losing their jobs. So in that sense, the Fed, last time the Fed achieved this, by the way, was 30 years ago in the mid 1990s, under very different circumstances. And again, here was an important point that Jay Powell tried to make yesterday. We're still at the tail end of the pandemic, and the pandemic changed things in the economy in ways we're still trying to understand. Like the fact that unemployment is so low and labor markets are tight. After raising interest rates by 500 basis points, you have to think about that. How did they actually pull that off? And people, graduate students are going to be writing papers about this for a while. So there is still a bit of a mystery. And as you suggested a moment ago, there are still risks. I mean, we talked about biological or geopolitical risks, and the biological risk hasn't entirely abated. And of course, the geopolitical risk has probably gotten worse in the last 90 days. So we have to keep our eyes on all of the above. And but to your main point, we do seem to have gotten right into the glide path that we'd like to stay on for the rest of the decade. We're lucky.
Yeah, it seems like across the country in any way. I mean, there's industries that are certainly affected that are interest rate sensitive, but overall, it seems like the economy is kind of on this in
Housing,
this good place.
let's face it, housing bore the brunt of whatever adjustment occurred, and there was an adjustment in the housing market.
And I think
But
Powell said the housing market is subdued, and he seemed to say that with a little bit of glee, which I didn't appreciate, but that is okay.
well, I think the he did allude to this. Somebody asked him a question. I can't remember her name. I think she was from Politico or Axios. And some of these newer media people are really interesting. They bring new sorts of perspectives to these, discussions to the press conferences. But somebody asked him about housing. The fact, of course, is that the Fed, can't control what happens in the housing market. But I'd go beyond that and say most of the problems we face in housing are a result of the fact that the supply side is all screwed up
No question.
by
Undersupply,
regulation and
no
whatnot.
question.
Undersupply, and we would love to build more, but nobody will let us. And so when you see these big movements in demand, when demand is repressed for a while because of high interest rates, things seem to be in balance. But trust me, over the next couple of years, as mortgage rates come down and housing demand revives, this old question of why aren't we building more homes is going to come right back to the front burner.
Yep, no doubt about it. Well, let's bring in Anders Hostelli, Senior Vice President at Guaranteed Rate, so we can expand this conversation into interest rates. So Anders, are you there? Well, Anders, good to see you again. Thanks for joining us. Appreciate you being here.
Yeah, thanks for having me again.
Yeah, and thanks for sending those market updates, especially when the Fed comes out with the types of news that they do, like they did yesterday. I know Paul appreciates the information as well. Well, the 30-year fix has been on a bit of a wild ride, right? 3 months
Right.
ago, we were approaching 8%. It
hmm
seemed like a couple of weeks ago, we were heading down, maybe even going to hit that 6%. Where is the rates today, and how did the bond market react to the Fed's news yesterday?
Yeah, it's interesting because there was economic news, that came out like let's say 3 weeks ago or so, and it started, bringing rates down. The 10-year Treasury started really dropping nicely. Almost, and I know we were talking offline about that. Sometimes what happens when the rates drop too much in a week or so, there's always a rebound. Rates will kind of come back up, or sort of a correction. And conversely, the other way, if rates all of a sudden go up for like a straight week, you'll tend to see them kind of cool off, or at least level out, right?
Right, you had that
So we
overshoot and it kind of corrects back
it's like an
down.
overshoot and then a correction. So what we but on what is today? Today is Thursday. Like on Monday or this week, rates started coming back down again, and you started seeing all of a sudden that it's kind of when you look at the benchmark right now, the 10-year Treasury was above 4%, and now it's back below. And that's really, helped bring rates down. So right now, what you're showing us is on a 30-year, I was pegging it looking again. I look at somebody with very good credit with like a 25% down. What does that look like? And it's in the mid high sixes which is right there with Freddie Mac. Actually, when this comes out, was this today or was this
This was
last
today. Yeah, this is the
today? Okay.
info from today that just
Yeah,
came
it's
out.
today, right? Yeah.
So you're right around that
Yeah.
six
No,
point
that's
six around that range. I have a
right.
question,
But yeah.
Anders. If how much would it cost a buyer to buy down a
Mhm.
rate, let's say the 6.6, buy it down to 6%? What would that cost?
So typically, so what we see is for every 1% of the loan amount that you pay as a discount point, you can buy the rate down by about 1/4% on the rate. So in
Okay,
other words, if you pay 2 points, then that would drop it by about 50 basis points or 0.5%. So then that would get you pretty close to 6%.
I see. So right
Yeah,
now, if you 2.5 points, you'd be at 6, maybe even a
right.
tad under.
Yeah, good credit, good, decent down payment, yes, exactly.
Okay, well, that's good to hear. And then we talked last week, last month actually, some changes to the jumbo loan limit for Hawaii, which was good
Mhm.
news. And where are those rates? Are those tracking close to the 6.3? Is there any separation between the two?
So yeah, conforming rates in Hawaii are up to 1,100,100,049. So almost anyway, it's quite a large number. But anything over that would be considered jumbo loan. And the jumbo loans, historically we would see times when it was much higher than conforming interest rates. And then there were times when there's a lot of liquidity, lots of investors looking for, investment opportunities and, mortgages, right? Or kind of a safe investment. Those rates at times would get even below conforming interest rates.
I see.
But with all the turmoil, things were going on last year, banking crisis, we saw the jumbo rates really jumped above the conforming rates. But we're starting to see, like, even guaranteed rate, we have our own jumbo rate program that we relaunched a month ago, and those rates are very close
That's
to
good.
conforming interest rates. Yeah,
Yeah,
so it's
that's
good.
good to hear. And then
Yeah.
what about adjustables? Is there much of a separation between the two?
There's still not too much of a separation. But I mean, there is I mean, if you look
Yeah,
at a shorter term arm, 3 and 5 year, you'll typically see that about 0.5 to 0.75% better rate than a 30-year fixed.
yeah. Okay, and then it seems like anecdotally in the real estate world,
Mhm.
the last 2 months have been really slow. Right. 2 months prior, January has felt like it's picking up. It's picking up steam volume wise.
Mhm.
Are you
Mhm.
seeing that at all in loan originations or loan locks?
We're seeing it definitely in loan locks. We are seeing more activity. I even look in my system and look at how many new applications or pre-approvals and leads that come in, and it's definitely on the increase. And we're seeing that as a company, across the board. And the mortgage banker stats kind of show a slight uptick. The thing that's helping us on the mortgage side too is there's definitely more refinance activity than we
Oh,
saw last year.
okay.
Is quite.
And then any changes in qualification? Are lenders tightening up? It's about the same, loosening
I
up?
would say it's about the same. What I'll say is on I know we brought it up before, the non-QM or loans that are outside of the box, we call them
Mhm.
non-qualified mortgages. There's definitely a lot more of investors or lenders that are out there saying, hey, we can do, where, it's an investor loan where they just qualify based off of the rental income,
I see. Got it.
or bank
Okay.
statement loans, those types
Well,
of
that's
things.
good to know.
So,
At least there
yeah.
hasn't been a restriction at all or
No, there's
contraction on
definitely,
that.
we don't feel a restriction. Yeah.
Okay.
Yeah.
All right. So Anders, I'm going to ask for your predictions
Uh-huh.
looking into the year ahead. Okay. And this is just yours. This is not
Right, right, just
guaranteed
mine.
rate,
It's
right?
not guaranteed rate.
So
Yeah,
make that clear.
disclaimer.
Okay.
Yeah.
Just the standard, our 30-year fixed benchmark in
Mhm.
June of 2024. It will be higher or lower, about the same as it is today.
To me, I think it's gonna be lower. I
Okay.
feel it's gonna be lower than it is today.
Okay. And what do you think that rate would be?
About 5 3/4, probably, right?
Okay, all right, okay,
Yeah,
all right.
yeah, yeah.
30-year in January 2025. So a year from now, higher, lower, about the same.
I feel it's gonna be lower, and I think it's gonna be in that low 5 range, 5 1/4 or so. So
Okay,
those are my predictions.
okay. And then one
Yeah.
last one's kind of out of your thing. What do you think home prices are going to look like in January of 2025? Higher, lower,
2020.
about the same. Year from
Uh,
now.
I actually think they'll probably be, kind of trending, kind of like historically a little bit higher, maybe 3 to
Okay,
5%. Yep.
all right.
Yeah.
Okay, well,
Okay.
we'll check back in a year and see how you
So we'll
did.
see.
So, yeah, Anders, always a pleasure. Thank you very much. And we're going to take a quick break. We're going to come right back with Paul Brewbaker and look at the housing statistics. So don't go
Thank you.
anywhere.
Bye.
Okay, and we're back with economist Paul Brewbaker. And by the way, if you're enjoying the information, please hit the thumbs up below and the subscribe button. It'll make Paul's day. Paul, did you want to add something to the conversation on interest rates and maybe even talk a little bit about that risk premium?
Yeah, Andrew's discussion was really interesting. The mortgage markets are like the bond market, are moving nicely to back towards a lower rate scenario that I think will hold for the remainder of this year. And the reason, of course, is that inflation has come down somewhat, surprisingly quickly in the second half of last year. You see this sort of inverted U-shaped profile. I think I'm certainly one of the people who was thinking it would be more inverted V-shaped, that it would, come down sooner and it would not linger as long as it did at a high rate of inflation. But it did come down hard in the second half. And in terms of this measure, the core personal consumption expenditure deflator on a continuously compounded basis, on an annualized basis, it's already gone right to the Fed's target of 2%. So the year-over-year numbers still have to catch up, and that's what the Fed's waiting for. If you look at the consumer price index measure, inflation, a different measure, tends to run about a half percentage point higher. Both US and Hawaii consumer price inflation has been in that 2 to 3% range, which is, probably the right zone, right? If the PCE deflator gets to 2%, then the CPI should settle in about 2.5%. So again, waiting for validation, that should come in the next few months. The other issue we've looked at for a year, and Anders has been talking about, at the time those interest rates were higher, so was the spread, the risk premium, or whatever the premium was, between mortgage rates and the risk-free rate, in this case, the 30-year fixed rate mortgage rate and the 10-year US Treasury note yield, right? A risky and a risk-free rate. That spread, which is shown in blue at the bottom of this chart, was as wide as it gets in the middle of a massive financial crisis, which we did not have last year. So that's been a bit of a mystery. And I would argue this year, in addition to the benchmark rates coming down, the risk-free rates, Treasury bond yields coming down over the course of the year as the Fed follows through on the expectation of lower short-term rates, I would expect that spread to narrow as well. Kind of a one-two punch of a lower benchmark rate and then a lower risk premium to help bring those mortgage rates back into a nice zone.
That spread really has been a mystery because there haven't been upticks in foreclosures or anything in the housing market. It's very interesting. Well, Paul,
there really haven't been good explanations to my knowledge.
Yeah.
I mean, I'm still waiting to hear a really compelling one.
All right, well, let's shift over to the housing statistics, and we're going to start with pricing. And we're going to kind of compare this and look back on the prior year. So these are the annual numbers, median price for Honolulu, information from the Honolulu Board of Realtors. So this is where we ended the year. The year to date, 1,050,000. Compared to last year, down 5%. And we're going to talk about long-term trend in a moment. Compared to 2021, it's actually up 6.1%. Now, compared to pre-pandemic 2019, up 33%, which I found pretty interesting. And we look back at 2019, we remember prior to pandemic, the housing market was just starting to cool down a little bit. And then the pandemic hit and we went through that crazy upswing. We look at condos, ended the year at 508, 500, basically flat compared to last year. Compared to 2021, up 7.1%, and compared to 2019, up nearly 20%. Paul, when you think about the pricing on the long-term trend line, where do you see this going? Where have we been? What do you predict is going to happen this year?
Yeah, I think Anders was on the mark. He conjectured that we'd be back on trend in terms of home prices in the coming year, and we've got a shot at that. The last decade or so has been a relatively tranquil one for Oahu home price movements. These are inflation adjusted. So we've been talking about inflation. Let's take the inflation out and just think about the sort of the pure value of the house itself, aside from whatever inflation is doing to asset prices generally. We don't have the cycles of large amplitude that we had 20, 30, 40 years ago. We had a very shallow sort of surge in price dynamics in the 2010s. As you mentioned, in the late 2020s, as the Fed first began to normalize interest rates, a little bit of subsidence, and then the pandemic hit. And remote work, the work from home phenomenon, caused home prices to jump. Now they're falling, right? So they went up 30% over 4 years, but they've backed off, let's say 5 or 10 percentage points by the time we're through, probably getting us back on this long-term trend. And now that inflation is going back to 2%, you can think of, let's say, 2.5% appreciation in real terms, plus 2% or 2.5% inflation, giving you, 4.5 or 5% nominal home price appreciation over time. That's kind of the right zone. One caveat: Hawaii has been underperforming the national economy substantially, not just post-pandemic, but even before the pandemic, a couple of years. We kind of went off the rails in 2017. And these are GDP figures by state, adjusted for inflation, real GDP. So an index, I line everybody up at the end of 2019, right here, right before the pandemic recession. And then I asked, so how did we perform since the end of 2019? Florida, the top 5 states, Idaho, Arizona, Utah, up 15 to 20%. Hawaii at the bottom of the pack, still down despite the recovery, albeit the slowest recovery, still down maybe 3%. And that's
Paul,
something.
What do you attribute? What do you attribute that to? I mean, I
Oh
can
man,
name a lot of things, but give me the quick list. Your top 4 quick ones.
Okay. Speed humps. Seriously, we're going to do that now. Speed humps. We dismantle telescopes in Hawaii. We don't build telescopes. Really, you shut down the refinery and you shut down the fuel store. I mean, I get that there are environmental climate change issues, but really, you don't want a refinery. You're going to go all in with solar panels that don't work at night. I mean, there are a bunch of policy decisions that have been made in Hawaii that I think are weighing. And then housing. Are you serious? There was 10 times as much housing produced in Maui 50 years ago, every year, than there was in the year before the wildfire, and certainly since the wildfire. Nobody seems to be building housing after 2,000 homes just got destroyed. So we're in this weird world in Hawaii. We're kind of stuck. Investors are, not really sure where to go. We haven't built an office building in 30 years, probably never will. We haven't changed the lodging inventory in 30 years. Even with all the undocumented vacation rentals seeking a pathway to citizenship, the number of lodging units is the same today as it was 30 years ago. What's the plan here? And I think that's a bit of a concern. Now, a house in Hawaii is still a house in Hawaii. It rules. So from that fundamental standpoint, I think the housing market is actually fairly valued and in good shape. But you have to remember, you got to have an underlying economy, connected to it all. And we seem to be working pretty hard on throttling
the other way. Yeah.
the real economy.
All right. Well, let's go back to housing statistics. And then I think this is where it starts to get interesting. Let's take a look at the closed sale data. Okay, so taking a look at the annual numbers, last year, 2023, we closed 2,560 homes in Oahu. That's down 26% compared to 2022, down 43% compared to 2021, and down 32% compared to pre-pandemic 2019. If we shoot over to condos, for the year, we had 4,573 sales. That's down 28% compared to last year, down 36% compared to 2021, and down 16% compared to 2019. And here are the interesting factoids that I've pulled out of this. Okay. If we look at the annual closed sales, on the home sales, this is the lowest number of sales since 1998. And it's the largest percentage decline since 1991, which was the implosion of the so-called Japanese bubble.
Yep.
On the condo sales, it's the lowest number of sales since 2012 and the largest percentage decline since 2008, right after the great financial crisis.
Yeah, leave that screen back up and let's think about those dates. Those are both really important dates that you pointed out. So 91 is the first year after the bubble, the Japan bubble, and you go into this long slide, downward slide in the 1990s, the bottom of which was 1998. And actually, if you bought anything in 1998, you look pretty good now. Same,
That's right.
and so post-Japan bubble and the bad hair decade of the 1990s for Hawaii, not for the rest of the country, for Hawaii. Another time, Hawaii was underperforming the rest of the country. For condos, as you point out, not the same cycle, but the next one, where when you go into recession, a huge decline in condo sales and volumes that, remember in the jobless recovery and all the, like the recession was over in 2009, but it took like years for people to really build back confidence.
Right.
And
If you
for
bought a
sales volumes to come up.
condo in 2008 at those prices, you'd be pretty happy today as well.
I think 2008 would have been a little early, but if you bought one in say 2011, yeah, pretty good.
Okay. Hey, Paul, let's just take a real quick break and we come back. I think this is the most interesting statistic that I found preparing for this, and this is the active inventory. So stand by. We'll be right back with economist Paul Brewbaker.
Yeah.
Okay, we're back with economist Paul Brewbaker. Again, if you're enjoying this information, hit the subscribe button below so you don't miss next month. And also give Paul a thumbs up down below. All right, Paul, this is the coolest stuff I think that I found for today's conversation. Active inventory. So these are the homes for sale in the last month of the year, 2023. This is where it gets interesting. Compared to 2021, there are 94% more single-family homes on the market. I mean, you're a buyer in 2021, you would love this, right?
Right, almost double is what you're saying.
It's almost double. And if we look at compared to pre-pandemic, we're still missing about half. We're down 50% of the inventory. So if you're a buyer from 2019, this would be a completely different world.
It's still tight.
And if we look at condos, we ended the year with 1,234. Again, looking back compared to 2022, that's up 5.5. Compared to 2021, it's up over 30%. Again, it seems like there'd be a lot more choices. Well, not seems, there are a lot more choices for buyers this 2022 compared to 2021. But again, if we go back to pre-pandemic, we're still missing 40% of that inventory. Is there anything other than rates coming down that's going to change this?
Well, I have my eyes on what the jurisdictions, not just the 4 counties, but also the state. There's this discussion at the legislature, what they're going to do about short-term rentals. In my opinion, IMHO, they don't need to do anything. Just let people do whatever they want. But of course, the political environment is, not where I am, let's say. And so, there are active discussions about not just suppressing short-term rentals in the short term, but even in the longer term. And that did play into what was going on in the condo market on Oahu pre-pandemic. So we should just keep our eyes on that. It's sort of in the back, in the backdrop. But no, interest rates going to be important. You have to remember, a lot of people locked in at 3%. So the question of what does it take for somebody to move when they got a really great mortgage and there aren't really organic, sort of drivers for moves.
Right.
There's
And that's
there's
the
not the
pile.
same economic dynamism
Yeah,
in
that's the
Hawaii
pile
that
up.
you might see it. Yeah,
And I
that's the
think
pile.
trying to take more short-term rentals off the market across the state is just going to be another dagger in the heart of the economy. But
Well, like I say, you could just, if we have a housing shortage, the solution is to build more housing. I mean,
more
that's,
houses.
but
Right.
that's the one thing we're not going to be allowed to do. So,
That's right.
ergo, you have to keep in your head all these other weird things that are happening.
Okay, so let's do something fun. Let's look at your predictions. This was last year, where we would be in today's world. Are you ready?
I shudder to think.
Okay. Okay, first of all, I want to just give you a little shout out. June of 2019 at our mid-year real estate review, and we were live. You said nothing will change this market except for a geopolitical or biological event. I remember talking to you after, I was like, what would a biological event be? And then COVID came. So this one you definitely nailed in June of 2019.
Sadly, sad to say.
Sad to say. So here we go. This was 1 year ago. Where would we be today? Paul's prediction. So let's start with inflation. So when we did the predictions, inflation was at 6.41. Your prediction is it would be lower. Of course, you were correct. So well done.
That was
all right. Next one, interest rates. 2023, we are at 6.13. You said lower. And in fact, you said, I'll bet you a mini plate lunch, it'll be in the low fives. So not only did you get that wrong, but you owe me a mini plate lunch.
You betcha. Although, and by the way, that's the weekly number through today, posted today. It's 6.64% for the whole month of January. And of course, it was up around 7% in November. But even though it is finally coming down, it's not coming down nearly as fast as would have been consistent with the 5%.
I think pretty much all economists across the country got this wrong.
And a big part of that is that 100 basis points of risk premium that we just don't understand.
Yeah. Okay. Home prices. So the median home price was 1,105. You predicted that it would be about the same. It's actually down a little, but yeah, you're pretty close. It's 100,000 among friends.
What's 100,000?
That's pretty close.
No, it's down. It's down. Let's be clear about it.
Yeah, it's down. It's down. Okay, then condo prices, which were sitting at 510, and you're pretty confident those were going to be higher, and we ended the year at 508, 500. So that one, sorry, I don't think you got that one right, Paul.
Well, and that's consistent, of course, with the fact that rates did not come down, and so the housing demand has remained under pressure.
Yes. Okay, and then would there be a U.S. recession in 2023? You said absolutely no, and of course you were 100% correct. And in fact, we're seeing pretty decent GDP growth. All right. Okay. Now we're going to get your predictions for 2024. We're going to talk about, I want your prediction for inflation, for interest rate, and prices. Okay.
At the end of the year. At the end of the year.
So I'll give you the question. I'll give you the question. And then you're going to do it. Okay, here we go. Okay. Wait, U.S. inflation rate in January 2025.
Sis boom ba. Name the sound of an exploding sheep.
Okay.
Say that again.
Okay. U.S. inflation rate in January 2025. Higher, lower, about the same.
Which measure? PCE deflator, I'm going to guess 2%, and the consumer price index, I'm going to guess 2.5%.
Okay. So
right in the Fed zone. Right in the Fed zone.
Okay. 30-year mortgage rates in January 2025, higher, lower, about the same as today?
Oh, lower.
Okay. And what do you think that rate will be?
5 1/4.
Okay. All right. 30-year mortgage rates in June of 2024, higher, lower, about the same?
June of 2024? I'm sorry, did I just do January 2025?
Yes, you did. Yep.
Oh, okay. 6 1/4.
6 1/4. Okay.
Yeah.
So down slightly.
Slightly, yeah.
Okay. Now, January 2025, home prices up, down, about the same.
You're writing this down, I hope, but yeah, up, I would say slightly, very slightly.
Okay.
We're going to get back on trend, but the question is, how fast, depending on how much rates can move.
Okay. How
And the
about,
trend is like this, the trend is upward.
yes,
So,
okay,
like
January
you see,
25, condo prices down about the same,
up slightly, yeah.
look up slightly. Okay. And then Paul, this is your bonus prediction for 2024. In January 2025, will Travis Kelce and Taylor Swift still be together?
Mm. Boy, not if the Republicans let them. I hope so. They seem really
Hey, all
happy
right.
right now. You know what I mean? They seem really happy. So we should all be that happy.
That's right. Well, hey, Paul, it's always a pleasure. Really enjoy the time. And thanks to Anders Hostelli from Guaranteed Rate Mortgage. And
For
again,
sure.
if you've enjoyed this information, please hit the subscribe below, hit a thumbs up. And Paul, we'll see you actually just in a couple of weeks. And we're going to do the statistics for this month that are going to come out. So for everyone that's watching, be well, be kind. Aloha.
Aloha.